the Business of Property podcast. I'm Simon.
I'm Stuart.
We're both property people running our own businesses. This podcast is just us chatting, as we often do, about anything and everything property. A couple of weeks ago, we dedicated our episode, sort of half by accident, to talking about replacing your salary with a property investment strategy called rent to rent. Or more specifically, what we ended up talking about was rent to HMO as a model. And we talked about what was involved in the inputs, both in terms of actual time and actual money, and how long it would then potentially take to achieve the goal of replacing an average salary. So moving on from the rent to rent strategy, we thought we'd look at another strategy this week, specifically sticking with the HMO theme, but looking at buying HMOs. Now, there's sort of two general sub-approaches within this. So one would be where you're buying with your own money. You're buying HMOs where you're paying the cash into the deposit, the stamp duty, the fees that are involved up front. And then the other sort of subcategory is where you're using external investor funds to provide the money to fund the deposit or the refurb fees or other sort of bits of startup cost. And then, of course, in both strategies, on top of the deposit and the input fees or input costs, should I say, you'd have mortgages. So that's sort of the framework of what we're going to talk about today. And we're going to talk about, again, replacing salary. So last time we took an average UK salary, which I think is about £30,000 a year. So that's our goal again this week. We're going to work out and talk through what we think is needed to actually achieve that through property investing with a strategy of buying and renting HMO properties. So we are going to have to make lots and lots of assumptions along our way today, Stuart. Let's start out with defining what our investment properties are going to look like. So I think in our chatting before the show, you suggested 5 bedrooms would be a nice sort of target for a standard HMO. But we're probably not buying 5-bedroom properties. So what do you think we might be actually buying in this scenario?
It's a good question. It depends. And as always, we should just caveat this by saying we are not providing any sort of financial advice whatsoever. These are just the ruminations and thoughts of 2 property people that get quite interested about this stuff. Don't take it as advice in any way, shape or form. But in terms of bedrooms, it's a good question because personally I buy existing HMO properties. So I do buy the number of bedrooms that I'm going to rent, typically. However, I don't think that's a standard model. I think the standard model is what you're suggesting, which is you might buy a 2 or 3 bed property and then you're going to convert a lounge, dining room into a bedroom or 2 to get it up. So as Simon has already said, I think we have made a tremendous amount of assumptions here to hopefully provide something interesting to people that are thinking about this, because it would certainly be interesting to me as someone starting out, depending on where you are in the country, because the other things, so we've talked about 5 beds. We've taken the average UK house price, which is around 250,000 at this point in time, which, interestingly enough, for me, for a 5-bed house, is very close to the sort of money I would be paying for that. I'd be paying a little bit less. Of course, depending on your location in the country, that might get you a hell of a lot more, or it might get you a hell of a lot less. But as Simon said, we're just taking a lot of averages so that we can just do a few calculations. But I think most people, if you're not working in an Article 4 direction, you're typically looking for something that is a 2 or 3 bed, probably 3. And then you've got downstairs where you might have a front room and then a dining room that you can convert and then ideally make it a 5 bed. My old modus operandi was to ensure that we were using and maximising the rooms as bedrooms, then looked at ensuring we had good communal space. And there is still definitely a need for that. Obviously, COVID had a bit of an impact. But these are the sort of things that you will be thinking about. I still try and make sure that we've got a kitchen dining area for properties, but we're going to talk about the numbers. So if you're looking to replace your salary, and just before I move on, Simon, did you have any other thoughts in terms of what we're talking about in terms of the property?
No, I think you're absolutely right. So I wasn't expecting you to actually say that you're buying it already as 5-bed, although, of course, somewhere in my head, I knew that's exactly what you do. It's the reason it matters for our scenario really is whether we're looking at, or how much we're looking at, the refurbs costing. Because if you're buying an HMO that's already an HMO, you probably don't have much refurb cost. You might need to repaint it and redecorate. And
that's
on.
highly debatable, because typically those HMOs in the market, unless you're buying at the top end of the market and you're essentially are just buying income, if you're buying income, you are paying probably the maximum price for that property, or the true market value for that property. If you're buying to invest and you're looking to replace your salary, which is the topic of this conversation, the likelihood is anything that you buy would need to have some work in it, because you'd want to be buying it at a lower value. But there's an interesting point in there actually about, and that's an equation we haven't thought about to work through, but it's actually, could it be easier to buy at the true market value and just buy that income, a ready-made HMO, versus the time taken? That's probably one for another day, and one that I could have thought about 5 years ago, which might have saved me a lot of time and trouble. But typically, my experience is that when we're buying HMOs, we are buying things that need work, and because they are going to be 5 beds and above, if you're replacing a kitchen, a bathroom, typically 2 bathrooms, and then redecorating all of the property, you're still talking about fairly sizable refurbishment costs. I would suggest anywhere from £20,000 to £25,000 upwards.
Okay, so that's great. We've got a number. So in fact, we've got 2 numbers now. We've got our purchase price of 250,000, and we've got our refurb cost of 25,000.
Let's start there.
Okay, great. So we're not entirely fixed on whether we're buying an HMO and then refurbing it, or whether we're buying a non-HMO and then refurbing it, and in that refurb process converting a dining room or a lounge or whatever to a bedroom. But we're going to go with these numbers: 250,000 to buy, 25,000 to refurb. What other numbers are we looking at to get started, Stuart?
So the big question on a lot of people's mind is loan to value. How much should we borrow? My personal experience is that, because I was always looking for the holy grail of getting all of the money out, as we've spoken about many times before, I was typically looking at mortgages with an 85% loan to value, which meant we were putting down a 15% deposit. Of course, you can look at 75%, or you can look at lower. You can look at any percentage you want. Obviously, the lower the loan to value, the more cash you're putting in up front, which for those of us looking to replace income generally isn't an option. So we're trying to put in the least amount of money possible, but that's where the next step comes in. So, but if we're looking at 15%, obviously you're putting in 37.5k against that 250k. So the bank's going to loan you the rest of that money, the 212,500. The other costs, obviously legal costs, you're going to have all your licensing, your certification that goes with that, stamp duty. I think we estimated about 10k. So
yeah, I think my calculations are for the current time 7,500, which assumes that we're living in a stamp duty holiday, but it's a second home purchase. So you've got that 3% on there still.
Okay, so just giving it the 3%. But all in terms of your deposit and other costs, I think we could say around 50k, actually. That's quite a nice round number on a 15% deposit. So you've got 50k to purchase.
That's without the refurb costs, yeah?
That's without the refurb cost, yeah. And then you've got 25k refurb.
Yeah, that sounds perfectly reasonable to me, and looks very similar to the numbers I've got in front of me, which I've just randomly made up.
So even there, you can see that if you've approached this as many of the education companies would be talking to you about replacing your income, that's fine to replace your income, but you need £75,000 to even start before we've even looked at the income. So let's look at the income, and then we can start talking about that a little bit more. So for my simple brain, I always have to work with very simple numbers. So what I tend to do is my rooms, I tend to average out on £100 a room, because that just keeps everything really simple.
Is that a year? Is it these really cheap rooms?
£100 a room per week. So if you've got 5 rooms, you've got £500 a week per room, and then you times that by 4.33, because that's the average number of weeks in a month, and that will give you a gross rental income of £2,165. So that gives you your gross income. And this brings us to...
Sorry, I'm interrupting, Stuart, but just on the sort of as a top line number, £250,000 property generating £2,165. As someone coming from a buy-to-let background rather than an HMO background, that's just amazing, brilliant. But anyway, sorry.
Oh, I thought you were going to say the opposite. I thought you were going to. And actually, let's do that quickly. So we've bought it. Well, actually, we can say because it's 26,000 a year. So we know that the gross yield on that is just shy of 10%. It's just above 10%, which, interestingly enough, tends to be what I stick out there as my first indicator as to whether or not I'm going to look at a property. And as you said before, yield can be pretty useless because that hasn't accounted for the amount we're going to put on the refurb. It hasn't accounted for the other costs. But for me, it's just a bit of a stake in the ground to say, could this property be of interest? So immediately, just working on our average figures, I'd say, well, it's going to be 10 and a bit % yield. So that is something we should look at. And one of my big learnings in property development is it's not the number of properties you have, it's the numbers in the properties that you've got. And this is where the devil truly is in the detail, because very rough calculations, if we're getting a 15% deposit, so if we've got an 85% loan to value mortgage, typically, I mean, the numbers have been in my head for some time, because banks like One Savings Bank, which owns Kent Reliance, will typically offer you anywhere between 4.29, 4.79. Actually, on some of mine, we've got 5.29. So you're paying quite significantly for that high loan to value.
I'm sorry, were they percentage interest rates on your mortgage you were just talking about?
Yes, they were.
Oh my goodness, they're high. Sorry, tell me those numbers again.
So some will be 4.29. I think 4.79 is an average one. Some of them are 5.29 I've had.
Ouch.
Yeah. So again, so the numbers look good for you, but and it's only when I started looking at buy-to-lets with you, I was like, oh, I'm paying quite a lot of money for my for my borrowing. But for the interests of this exercise, I've based it on a 4% to not be too harsh on the HMO. But probably, to be fair, we should be looking at probably 4.5%.
Yeah, based on the numbers you've just said, I think 4.5% sounds better. But just to clarify, this is high loan to value, HMO, limited company mortgages.
Correct. So you've just thrown in the limited company there. You snuck that one in. But so I'll underscore that as well. So you're absolutely right. So that is also under limited companies. But I think the personal ones are similar. I'm sure I had a personal one which was very similar rate, to be fair.
Okay. I think 4.5%'s a bit higher than I might have expected. But as you say, it's covering a number of factors that do tend to increase it. So let's go with 4.5%. I think that's a good number to use for our calculations.
Okay, so you're paying 4.5%, which is £9,500 a year.
Yep, or £796 a month, give or take.
Yeah. So let's call that 800. So you're paying 800 a month. Okay. So you've got 800 a month interest repayment. So we're paying interest only. We're not paying any capital down. We're paying the £800. The things with multi-let properties, you're going to have maintenance costs. I would conservatively say, and this is conservative for me, £150 per month. Some months it's going to be, some months you might, there is always a month where we're doing something in a property. And if I went back through all of my statements of the 60 odd rooms I've got, I'm pretty confident that is the case. But let's say 1 month, it might just be a light bulb, or the fridge has gone down, or the tumble dryer's broke. And again, you're talking about properties. But so let's just say £150 for maintenance.
That's across the whole property, yeah.
That's across the whole property.
Yeah.
You know, doorknobs, chairs, you name it. I'll share this with the audience, the listeners so far. So I got a great one last week. I got a text from one of my wonderful tenants, who's a great guy, by the way, but sent me a text saying, "Dear landlord, we seem to have run out of Hoover bags." And that was the statement to which I responded, "Well, I know a few establishments that might sell you those." So anyway, digress slightly. You're then going to have, I've mentioned it at the start, but you've got things like HMO license. We talked about this on the last episode, but HMO licenses, the prices vary council on council. And I know in the council I operate in Plymouth, that the prices have gone up, I would say over 50% in the last few years because of the number of HMO properties. So I think you can pay anywhere between £500 to £1,200. And I know there are probably other areas that I'm unaware of where it could be higher.
Yeah, there are some areas that charge in proportion to the number of rooms in the property and all sorts of things that go up much higher. Yeah, this is something that PATMA has data on across the whole country as information, all the HMO licensing costs for the different councils. So yeah, that's if anyone wants to have access to that, that's within the PATMA Prospector Pro product.
Very good. So you've got those costs, which I don't typically spread out across any particular time, but because 800 bills and 800 bills, so I don't know how to amortize that, but they're just things that I'm raising that you probably want to factor in, because they will happen if it's brand new. You're going to need those monies. I've sort of factored in around £200 gas and electric, which is about average for that sort of type of property. Again, areas will change. The other thing, so my properties typically, they're all bills included. So we will pay that. We'll pay the council tax. We'll pay the broadband. We'll pay the TV license. So everything. So there are other costs that you might want to factor in. But as a miscellaneous, I'll just add another 50 quid to my numbers. And essentially what we've got to there, 1,050. So already we're up to just over £1,000. So it's about 1,200.
I've got a couple of questions. You mentioned 200 for utilities. Was that including council tax?
No, just gas and electric.
Right, so it's gas and electric. And you've got council tax in there as a separate number, have you?
I hadn't added that, but if I were to add it, I'd be adding around £140.
Okay, so I think we should probably add that in.
Yeah.
And the other big thing that you haven't mentioned yet, maybe you're coming on to it, but is some kind of allowance for voids. Because being an HMO, you tend to see a higher turnover of tenants. So what do you think should be a void allowance?
Well, the calculation I use is usually 1 month. I mean, in terms of this exercise where I'm working out the net profit, I don't apply the void because I am forecast. Don't look at me like that. Don't look like I'm a naughty boy. But it depends on the size of the property. If I'm looking at an 8-bed, I actually don't plan for it as an 8-bed. I look at it as a 7-bed or a 6-bed. That's how I do. On a 5-bed, and we do have 5 beds with very small single rooms. And I think there's some interesting information for people here and things I wish I'd known earlier, because you might get a group of 4 if we're talking students. Obviously, that's not going to happen if you're looking to professionals. But if you're renting to students, typically they might not want to take a smaller room, but then we'd upweight the weekly cost a little bit to make up for the loss of that room. But I think if you take one, basically just 1 month's rent out, not at the full level, so not the 2,200, but my calculation, it's a weird calculation, but it comes to around a quarter of the gross rent. So it would probably be around £400 to £500 if I was allowing that, like on a first month basis.
Okay, so that would be nearly another 50 quid a month, sort of spread out. I think you're being very optimistic, may I just say. But do you think something in that region then to allow for?
Probably about £40.
Okay.
Yeah.
Let it be noted. I think you're being optimistic, but okay.
No. So to be clear, I wouldn't allow. So two different things here. If I'm planning a property, but I wouldn't allow £40. No, in that month, I'd be estimating about £400 would come out of that month. So I'd put in a figure of £400 to come out of that gross rent, not £40 a month.
To come out of that month, do you mean the first month when you're setting it up, or do you mean? Okay, yeah. So I'm looking at that sort of as an ongoing churn, if you like. So a recurring cost, because tenants come and they go, and you have to find new ones. And there's normally a bit of a gap between that.
Yeah, I mean, on if you're forecasting that way, I would say anywhere between 5 and 10%. Take 5 and 10% off your gross rent. Just so if we look at 2,200, I'd say knock £200 off your gross rent, and that would cover you, because that covers you for 2,400 a year, which is just shy of, well, it would be 10% of what your income is going to be. So I don't disagree. I think it depends how well you know your area, your property, and your models. But so for this exercise, let's add another £100. I'll meet you in the middle. But then we've got 150, 190, 240, 440, 590. So we're coming up to about £1,400, in terms of all of our costs. And I think
including mortgage interest, yeah.
Including mortgage interest, yeah. So we won't go back through it, but I think this is just interesting to know. If you're planning, how do I replace my salary? I think, and personally, from personal experience, I think that's a good number based on what we've got. Because what I can now see is that of the gross rental income of 2,165, we've now got just over £700. So we've got £765 a month, which actually I think is a good figure.
And just to throw in one more clarification there, presumably you're looking at self-managed here, so there's no agent cost.
That is a very good point. If I was going to take an agent cost, I'd add 12%.
12% of gross rent, just to clarify. Yeah.
Yeah, so that would add another 260. So where you'd come out with, if you did put that on, you'd come out about £500. And the funny thing is, when I work up a property on this number, my first thought is, if I can get to net of 500, I'm looking good. And it just shows you there is a method in the madness, because all of the things we've done there have brought us actually to that number. So those numbers come from somewhere. So I think we should stick with that number, because that's a nice round number, 500.
Okay. And that fits quite nicely with somebody who's trying to build a salary replacement investment on the side. So you don't have time right now to do the self-management. Maybe you will when you've replaced your salary and you've given up your day job. But right now, you've still got the day job. You're trying to replace your salary. You can't do the management, so hence use an agent. Good. So, okay, we've got £500 a month of income from this property.
Yeah, and if you had the average UK salary, you'd need 5 of those.
Yep, indeed. So we need 5 HMO properties that look like we've just described. And we needed £75,000 to buy one. So, Stuart, person with a calculator, hopefully. What is 75,000 times 5?
Well, this one I can do in my head. It's 375. Yes, you'd need 375 grand.
I'll take your word for it. I can't do that in my head. Well, I can't at the speed required on a podcast. Right, sorry. What was that? I've missed that number. You said
375.
£375,000 to put in to build a portfolio that can provide your salary as an HMO strategy. Now, I think that's actually not too bad, really. So that's an ROI of 8%. So if you've put in £375,000 and you're getting 30,000 out, that's 8% per year. So that's okay. That's a pretty good return on investment. You're using an HMO strategy, so it's higher profit, or should be higher profit. However, that is allowing for using managing agents to do a lot of the work for you. So yeah, if you've got £375,000, I think that's pretty good return. The other thing we've not covered here is the time required to do this. Where we were coming from with some of this discussion was getting rich quick and replacing your salary quickly, which we sort of think is probably not very true. So how long does it take to buy one HMO property? As in, to research the market, find something, do viewings, put in an offer, get it accepted, go through the legal process, and actually come out the other end owning a property?
Well, this is the interesting point. And of course, there are many different ways. And like everything else, the more you do, the easier it becomes. But you're so dependent on other parties. You're so dependent on the conveyancing process. But if you buy it cash, it's going to be a quicker process than mortgage, and lots of problems come up. The one bit I just want to step back to quickly. So the first thing is, most people that are sitting around thinking I need to replace my income aren't going to have 375k burning a hole in their pockets ready to go. And that certainly wasn't my case. And I was on a very good salary before I decided to embark on this. And it brings into the other point is, well, how can you do that, and how can you scale? And the other, just watch out on that. So we've just done a very quick ballparks and estimates on that. But my experience tells me is that there are so many things that you just cannot. Well, you can plan for them. You can plan for a boiler and you can plan for a roof repair. But my experience is that all of those things and more happen a lot more frequently than you're going to expect, and things become a lot more costly. So although I'd be happy with the net profit of 500, and that is typically what I'll work on, that doesn't account for when we had really bad weather in the southwest and 2 roofs went. One of the properties, which is a 2-bed property I've got, the amount of things that have gone wrong with that in just 1 year is staggering, and it's probably it's wiped out any profit for at least 2 years, and that's not even a joke. I mean, it's we've had to re-roof it, we've had to redecorate it multiple times. So it all sounds good on paper, but these are the things that eat away at net profit and therefore eat away at your capability. And this isn't to be a naysayer, because it's all possible and we're in the industry. It's just to say this is the reality of this sector and what we do. But buying it brings another point. So again, most of us aren't saying, well, I've got 375k, I'll just buy myself my salary. This is where it leads us into, well, how do we get our money back out quicker? And that's why I went for 85%. The other point we didn't talk about was actually, if you go for a 25% mortgage, yes, you're going to put in an extra 25k, but actually you're going to make an extra £200 a month. So it might take you 10 years to get that money back, but it's the difference. And of course, your net profit is higher. But I personally went down the route of seeking personal private investment. And that then also added what we call in finance the downward pressure, because not only did I have to pay the banks their interest, I then had to pay an investor interest and think about paying him his money back at a certain stage too. So there's those 2 factors.
We've been working out a lot of these numbers as we go along, but I think it's just worked out brilliantly, in so much as if you go down the private investor route, there are various reasons why you can't do this, but you wouldn't be able to do it for the whole figure. But let's just say you take the whole figure, 375,000, and you are able to gain that from an investor or multiple investors. Typically, the kind of return those investors need or require or ask for, whatever is made available to them, is in the region of 5 to 10%. So if we take a number that's kind of in the middle, say maybe just off the top of my head, 8%. So we're now paying 8% interest per year on the £375,000 that we've borrowed in order to buy these HMOs in order to replace our salary. That means we're paying £30,000 a year of interest. We've just lost our salary.
Yeah.
And we're making absolutely nothing. We've gained 5 HMOs. We're doing a lot of work. We've probably spent over a year in actually finding them and going through the purchasing process on them. And because we've funded it entirely with investor money, we actually end up with 0 at the end of it. We have not replaced our salary at all, and we haven't even generated any income. That's not really what we had planned.
And this is where it gets into, because I think to look at the bigger picture is really good, but this is where you then have to focus in on the property, because if you're buying a property at the right price, if you've done the right work, then you know where the value is. So there are some properties, now I'll give an example. So I bought one property for £540,000. Now it was actually 2 properties on one freehold. I spent, unbelievably, around £20,000 on it. It was a 13-bed. I can't go through all the numbers. When we revalued it, it revalued at 735. So on that one, I think we paid 30%. So let's just say that's roughly 150k plus your stamp duty. So we had 150k in plus stamp duty plus the refurb of 20k. So we had 170k in. Actually revalued at 735. And even if we went in at a 70% loan to value on that, that comes out at just under 515,000. And so there are models where you can say, well, actually, I can use investor finance, but I have to have a lot of confidence in what we'll call as developers a gross development value, or just what we believe the end market value to be. And as we know, and the biggest risk to us is that, unfortunately, in property, we have so many dependencies on others that's where the risk comes in, because we may believe the property's worth I actually put in a valuation of 750. I didn't think we'd get close to it, but as we know, valuer might come in and say, I don't value it at that. I value it a lot less. I'm hearing that one bank now will limit valuations up to sort of 70%, even if they were going to give you a product of 75% loan to value, they will now only give 70% on a valuation. And all of this, dramatically impacts. So, when you're someone like me that does borrow finance at typically between 8 and 10%, that is, it's not for the faint of heart.
Exactly.
Yeah, I think as Sir Alex Ferguson used to call it, it's always squeaky bum time.
Yeah, you've got to do more than the basic model that we've just spent the last half hour talking through. You've really got to, as you say, add a bit more value to it and actually go through that refinance process as well. So obviously we're sort of merging a little onto another strategy of buy, refurb and refinance. So you've got that refinance bit so that you're gaining some of your money back to repay your investors or repay yourself or what have you. And that's how you can make the numbers come out at not zero in the end. I think the other potential way, just looking at the main scenario that we've talked through today, is if you self-managed. So we were knocking 250 quid a month out roughly for agent fees. So if you self-managed, you're making yourself another job. It's not something you can do on the side, particularly, especially with an HMO, because management's relatively intensive. But that would then mean that you've got £250 profit a month per property. So to replace your salary, you now need 10 properties instead of 5, but at least it's not zero. As in, at least your income, your profit at the end of the day isn't zero.
No, that's right.
Can get something out of it. Yeah,
because the agent fees alone are 10% of your gross annual. So if your salary was 30,000, that 250 is $3,000 a year. So you can see there that's 10%. So that's how significant that is. The challenge for a lot of us is what we don't want to do is trade in a job for a job. So depending on what that is, and HMOs can quickly become a job. But that's absolutely fine if that's something you're comfortable doing. And like everything else, it happens in cycles depending on the size of the portfolio.
Indeed. So we are definitely over time for today. But I think we've had quite a good run through of the calculations. Is there anything you think we've missed in this process, Stuart?
I'm sure there are many things that we've missed. I mean, in terms of the average, I think the last thing you mentioned is the refinance. So we do a lot of refinance, and of course that further borrowing, because again, we're not going to have 365k kicking around. So what we want to do is get that money out of the property as soon as possible. So if we bought a property for 250, assuming we've spent more, that we've estimated 25, which I know some people are saying is really low. Some people are saying, well, that's all right. But if you spent, let's say, between 25 and 50k, you should have increased the value of the property if you've bought it right. And that being so, within 6 months, you might be able to borrow further borrowing against it. And my experience is that further borrowing, of course, when you borrow it, that's another interest payment that also comes out of your net profit of the property. But it will mean you've got some cash back in your pocket to go and buy the next one. But my experience is that really does mean your net profit suffers as a direct result and can mean things take longer. The other things, of course, we didn't include in the numbers, but we were rounding them up, was insurance. You'd need insurance for all of that. Typically for HMOs, all properties, obviously you need insurance, but you need specific insurance. And the more rooms you get, the harder, the more specialised the insurance is because of the properties types that they are. We haven't talked about HMOs in commercial, but of course we're just trying to think about that replacing salary. But I think that is a very good sort of broad brush way of thinking about how to replace a salary for anyone that is thinking about it. I think that's a great starting point, because then I think after this, you then have to start thinking, okay, now what are the creative ways that we can do this without, seeing if a lucky member of the family's got a 400k that they'd like to invest in my new property business.
Yeah. There's one more sort of angle to this, which we hinted at, but I don't think we finished talking about, and that was the time it would take to actually accumulate all of this. If we say finding and buying a property takes 6 months, but you can overlap them, say 2 months into the process, you can start going to the next one. So if you overlap sort of 4 months in each process, so to get 5 properties, assuming I've done my maths right, you need 14 months. So this isn't going to be an instant process, and I think 14 months is a bit optimistic still, but perhaps, just maybe, with nearly £400,000 and 14 months of work, you could replace your £30,000 salary with an HMO purchasing strategy. If you're using other people's money to finance it, that's not going to work, probably. You will need more HMOs or more work to go in, or a more complex refinancing model. But if you've actually got the capital to put in and you want to go into property and you've got the 14 months, you can probably replace your salary in the HMO property investment. So there you go. No more property courses or training required by anybody listening. You know exactly what to do. When you've gone out and executed on this and succeeded brilliantly in 14 months' time, assuming we're still podcasting, please let us know.
And send us a cheque for £97. Thank you.
On that note, we are finishing up for this week. I very much hope that you've been enjoying our mathematical ramblings this week. And I would really appreciate it if you could let somebody else know about this podcast and your hopefully enjoyment of it. Show notes and some mathematical calculations probably will be available at thebusinessofproperty.com. And Stuart and I will talk to you again next week.